So I want you to try and imagine an investment scenario that, honestly, it sounds completely impossible right out of the gate.
Okay, listen.
Right. So picture yourself holding a portfolio and it's got a stock in it. You are sitting there watching the ticker blink on your screen, but you have somehow magically engineered a situation where you completely, I mean 100%, stop caring whether that stock's price goes up or down tomorrow.
Oh, wow. Yeah, that does sound like a fantasy for most people.
Right. Because it could absolutely skyrocket, it could plummet all the way to the earth, and you feel absolutely nothing. There's no anxiety, there's no thrill, no stress at all. And yet, despite this totally zen-like detachment from the direction of the market, you know precisely, like down to the exact penny, what the value of your portfolio is going to be today, tomorrow, and the next day.
It really sounds like a paradox, doesn't it? Because, normally investing is entirely about predicting the future.
Right. It's all about the guessing game.
Exactly. We obsess over where the line on the chart is going.
Yeah.
People read earnings reports, they watch the Federal Reserve, they look at moving averages. But the scenario you are describing right now, where market direction basically becomes completely irrelevant to your actual outcome, that is actually the foundational bedrock of modern quantitative finance.
And that really is exactly our mission for this deep dive today.
Yeah.
We are going to demystify the absolute core of quantitative finance.
Yeah, we're unpacking a specific lecture, I think it was just called M1L2, which covers what's known as the binomial model for valuing options.
Yeah, the binomial model, which honestly, it's such an incredibly powerful framework because it strips away all the mythology of what Wall Street actually does behind closed doors.
Right, it reduces it all to pure logic.
Exactly, because when people hear terms like quantitative finance or derivatives pricing, they immediately think of supercomputers.
Oh yeah, algorithmic trading, Greek symbols covering a chalkboard.
Right. You feel like you need a PhD in stochastic calculus just to look at the math. But the goal here for you, the listener, is to understand the core mechanics of how options are priced using nothing but basic arithmetic, like literally just addition, subtraction, and some logical deductions.
And it's wild because from those really simple kind of Lego block building materials, we're going to reach some truly mind-bending conclusions.
Yeah, conclusions about risk, probability, and just how financial markets physically function under the hood.
What is really fascinating about this approach is that we have to completely abandon the standard mindset, like the mindset of a trader who is trying to guess the next card at the blackjack table.
Right, we aren't gamblers today.
No, not at all.
Yeah.
We're going to look at the market like a structural engineer who's building a suspension bridge. We're going to literally construct a mathematical architecture that isolates and neutralizes risk entirely.
Okay, I love that analogy. Let's start building. So to get this off the ground, we need the simplest possible sandbox to play in.
The absolute most basic environment.
Right. We are stripping away all the noise of the real world. So no inflation, no geopolitical crises, no unpredictable wild market swings.
Nice, clean laboratory conditions.
Exactly. So in this isolated sandbox, we have a stock. And today, right now, that stock is currently priced at exactly $100.
Perfect round numbers. I like it.
Always. Now, between today and tomorrow, this stock is going to take one of two possible paths.
It's two.
Just two. There are no other alternate realities here. It will either rise to $101 or it will fall to $99. That is it.
Okay, so no staying flat at 100.
Yep.
And no crazy jumps to 110. Just up $1 or down $1.
You got it. And to keep our laboratory conditions perfectly sterile for this first run-through, let's assume interest rates are set at exactly 0.
Right, which means we don't have to worry about the time value of money yet.
Exactly. No inflation eating away at cash under a mattress. $1 today is exactly equal to $1 tomorrow.
Okay, that makes sense.
Perfect. So alongside this stock, just floating in our sandbox, we also have a call option. And this call option has a strike price of 100 and it expires tomorrow.
Okay, so let's clarify that. For anyone listening, that simply means tomorrow, if the stock goes up to 101, this option contract allows you to buy the stock for 100.
Right, so you immediately pocket that $1 difference.
Yep, the option pays out $1.
And in the alternate universe where the stock falls to 99.
Well, the option would be completely worthless. You wouldn't use a contract to buy a stock for 100 if you could just buy it on the open market for 99.
Exactly. So it pays out 0. So we have our setup. We know the stock's current price. We know its two possible future prices. And we know exactly what the derivative contract, the option, will pay out in either scenario.
Right, up $1 or 0.
So the ultimate question we have to solve in this deep dive is, what is the correct, theoretically fair value of this option today? What should it actually cost you to buy this ticket to the game?
And to make it interesting, let's say we have one more crucial piece of statistical information.
Okay, hit me.
Let's say we have done our fundamental analysis, we've looked at the order flow, and we estimate that the real-world probability of the stock rising to 101 is, let's say, 60%,
Okay, 60% chance it goes up.
which naturally means the probability of it falling to 99 is 40%.
Right, so our statistical forecast says it is more likely to go up than down. But, here is where I look at this setup, and my brain immediately just goes straight to the casino.
Oh yeah, the gambler's mindset.
Exactly, because when I look at this, I just see a rigged coin toss. Like, if I know a coin is going to land on heads 60% of the time, and I win $1 when it lands on heads, and I get absolutely nothing when it lands on tails, isn't pricing this option just a matter of basic betting odds?
I mean, that is the most intuitive leap a human being can make. It is how almost everyone naturally approaches the problem of risk and reward in the market.
Because it just makes intuitive sense. You take the probability of winning and you multiply it by the payout.
Right, the expected value calculation.
Exactly. A 60% chance of making $1 gives you an expected value of 60 cents, and a 40% chance of making 0 is just 0.
Right.
You add them up, and the expected payout of this option tomorrow is 60 cents. So, logically, to me, the option should cost 60 cents today, right?
Well, if we connect this to the broader reality of global finance, calculating simple betting odds is exactly what we are not going to do.
Wait, really?
Yeah, if you try to price options using that gambler's logic on a real trading floor, you will be systematically dismantled by professional market makers in about 5 minutes.
Okay, wait, why? If the basic probability math is right, 60% times $1 is 60 cents. Why is the price wrong?
Because to find the true, mathematically unassailable option value, we have to fundamentally shift our identity. We have to stop thinking like a gambler who accepts risk, and we have to start thinking like the institution that actually runs the casino.
Oh, I see.
We have to think like a market maker.
Okay, let's break that down for a second. What is the actual psychological difference between the two?
So a gambler looks at that 60-40 split and says, I like those odds. I will put my money down, cross my fingers, and embrace the uncertainty.
They accept the directional risk.
Exactly. But a market maker, the bank, or the institution that is actually selling you that options contract, they despise risk. It is completely toxic to them.
Really? Because you always think of Wall Street as these massive risk takers.
They really aren't, at least not in this context. Their entire business model is not about making speculative bets on whether the market is going up or down today.
Right.
Their business model is collecting tiny transaction fees millions of times a day while maintaining absolute neutrality.
So they just want to collect the toll on the bridge.
Exactly. If they sell you that option, they do not want to sit there sweating over whether that 60% chance hits or misses. They want a guaranteed ironclad outcome regardless of what reality does.
Ah, okay. So they want that impossible scenario I described at the very beginning of the deep dive. They want to be involved in the asset, they want to hold the positions, but they want to completely sever themselves from the emotional and financial roller coaster of the stock's actual direction.
Precisely. They want to operate in a complete vacuum of certainty. And the mechanism they use to achieve this state of total detachment is really the absolute beating heart of quantitative finance.
Okay, what is it?
It is a technique called delta hedging.
Delta hedging. Okay, let's open up the hood on this. How do we actually engineer certainty out of a profoundly uncertain market? How do we build this magic shield inside our one-day, $1 sandbox?
We do it by recognizing that the options simply cannot be priced in isolation.
What do you mean?
The option and the underlying stock are inextricably linked, right? So we construct a very specific, carefully balanced portfolio that combines the two of them together.
Okay, so we are building a kind of hybrid vehicle. The framework requires us to hold one of these call options. We don't know its price yet. We're still trying to solve for that, but we own it.
Right, you have the option in your hand.
And simultaneously, to balance it out, we short sell exactly 1/2 of a share of the underlying stock.
And we should probably clarify how this mechanism functions mathematically for people, because normally you are just buying assets. But here, we have a positive exposure and a negative exposure happening at the same time.
Right. The short position means we have effectively borrowed half a share, we sold it for cash today, and we are on the hook to buy it back tomorrow at whatever the new market price is.
Exactly. It is a liability that inversely tracks the stock.
So if the stock goes up, my liability gets more expensive, I lose money on the short.
Precisely. You hold one option, which loves it when the stock goes up, and you have a short position on one half of a stock, which absolutely bleeds money when the stock goes up.
They're fighting each other.
Yes. Now, let's stress test this hybrid vehicle. Let's walk through the conceptual math of what happens to this portfolio tomorrow in both of our two possible universes.
Okay, let's run the UGG universe first. The sun comes up, the opening bell rings, and the stock has risen from 100 to 101. What is the net reality of our portfolio?
Okay, so we evaluate the two opposing forces. First, the asset side. You hold the call option, the stock is at 101, and your strike price is 100.
So the option is in the money. It pays out exactly $1. So I have a positive $1 on that side of the ledger.
Good. Now, let's look at the liability side. You are short one half of a share. Today, a full share costs $101 to buy back in the open market.
Which means my half share liability is going to cost me exactly $50.50 to cover.
Right.
So I have a positive $1 from the option, but I owe $50.50 on the short position. If I net those two things out, my total portfolio value is negative $49.50.
Firmly, undeniably, negative 49.5.
Yeah.
That is your reality in the up universe.
Okay.
Now, let's completely reset the simulation. What happens in the alternate universe? The sun comes up, and the stock has fallen to 99.
Okay, let me run the opposing forces again. So the stock is at 99. My call option with a strike of 100 is now totally underwater. It is worthless. It pays out 0.
Yep. And the liability side?
Well, I am short half a share. A full share is now cheaper. It is only $99. So my half share liability only costs me $49.50 to buy back and cover.
So net them out.
I get 0 from the option, minus the 49.5 I owe to cover the short, which leaves my portfolio value at negative 49.5.
Look at the two outcomes. Just sit with that for a second. Wait.
It is the exact same number.
Exactly.
If the market surges up to 101, my net position is negative 49.5. If the market crashes down to 99, my net position is still negative 49.5.
This is the real aha moment. This is the ultimate magic trick of quantitative finance. You have just constructed a perfectly risk-free portfolio out of two incredibly risky assets.
That is wild.
You've mathematically eliminated the future.
You know, that requires a massive psychological shift to fully appreciate, because in normal investing, uncertainty is just the water we swim in. The future is this fog of probabilities and educated guesses.
Right, you never know for sure.
But here, by using this specific mathematical counterweight, holding the derivative and shorting a precise fraction of the underlying asset, we have perfectly isolated and neutralized the directional risk. We have built this invisible, impenetrable shield around the portfolio.
And the industry term for that shield is delta hedging. You have hedged away the volatility. You have locked the two opposing forces together in such a specific way that their movements perfectly, flawlessly cancel each other out.
So no matter what the chaotic, screaming reality of the market does tomorrow, your financial outcome is locked in stone today. Okay, so we have built a portfolio whose future value is an absolute mathematical certainty. Which brings us to the most crucial logical leap in the entire framework, I think. Because establishing this guaranteed future value is the key that finally allows us to unlock what the option is actually worth today.
Yes. This is where we introduce a concept that is as fundamental to the laws of finance as gravity is to the laws of physics.
Okay, lay it on me.
It is the principle of no arbitrage.
No arbitrage. We need to define that carefully, because no arbitrage sounds like a piece of really dry financial jargon. What does it actually mean for the architecture we are building here?
It is basically the fundamental law of equivalent exchange. It states that if two completely different investments produce the exact same guaranteed cash flows in the future, they absolutely must cost the exact same amount of money today.
Okay, that makes intuitive sense.
Right, because if they didn't cost the same, the fabric of the financial universe would tear open. People just buy the cheaper one and sell the expensive one for free money.
Let's ground that in our sandbox numbers, though. We know with absolute 100% certainty that our hedged portfolio is going to leave us with a net value of negative 49.5 tomorrow.
Yep.
And remember, our pristine laboratory conditions Interest rates are zero. There is no time value of money complicating things.
Hmm.
So if a portfolio is guaranteed to be worth negative 49.5 tomorrow, what is the only logical, rational price it can have today?
It must be worth exactly negative 49.5 today. Not a fraction of a cent more, not a fraction of a cent less.
Because, as the logic dictates, there are basically two separate ways to guarantee you end up with negative 49.5 tomorrow.
Right.
First, you could do all this complex financial engineering, buy the option, short the half share, set up the hedge.
Oh,
Or, second, you could literally just write an IOU for $49.50, put it in a drawer, and wait 24 hours.
right. Both of those portfolios carry exactly zero risk. They are functionally identical in terms of their future economic reality. Therefore, the market absolutely demands that they have the exact same price today. You just cannot have two different price tags for the exact same guaranteed outcome.
So we can distill this entire complex dynamic down into one very simple, elegant algebraic equation. The net value of our portfolio today is simply the unknown price of the option, which we have been trying to find this whole time, minus the cash we generated by shorting the stock today.
Let's lay out the components of that equation for everyone. You have the option price, let's just call it V,
Okay.
and you have the short position. You shorted 1/2 of a share at today's price. Today's stock price is 100.
So I collected $50 in cash today from that short sale, which makes my portfolio equation. The unknown option price V minus the $50 from the short must perfectly equal the guaranteed future value of negative 49.5.
Now you just solved the equation for V.
It is just moving numbers across the equal sign. We take the equation V minus 50 equals negative 49.5. We add 50 to both sides to isolate V, and we get V equals 50 minus 49.5.
And the result is?
V equals 0.5. The options value is exactly 50 cents.
There is your undeniable truth.
Oh, yeah.
That is the true, mathematically sound, fundamentally correct value of the option.
Okay, hold on. Let me stop you there. I really need to push back on this because my brain is doing absolute somersaults right now.
What's the problem?
Look at the incredibly elegant math we just did. We balanced the portfolio, we equated it to the future guarantee, we solved the algebra, and we arrived at a precise valuation of 50 cents.
Right.
But let's rewind 10 minutes. Earlier, we talked about the real-world probability. We explicitly stated there was a 60% chance the stock surges up and a 20% chance it crashes down. And my gambler's expected value calculation said the option should logically be worth 60 cents.
Yes. But your gambler's calculation relied entirely on the directional probabilities.
Exactly. But in this new delta-hedged math we just executed, we never touched the 60%. We never touched the 40%. They didn't even enter the equation.
No, they didn't.
We looked at the current price of 100. We looked at the future bounds of 101 or 99, and we solved it. The probabilities completely vanished into thin air. How is it conceptually possible that the probability of a stock rising is completely, entirely irrelevant to the price of a bet on that exact stock?
You have just stumbled onto what is arguably the most profound, counterintuitive realization in all of derivatives pricing.
It feels crazy.
It does. And the answer to your question is entirely dependent on that invisible shield we built. The probability of the stock rising or falling, its expected growth rate, its bullish or bearish momentum, is completely irrelevant because we hedged it.
Because we mathematically forced the outcome to be identical in either direction.
Precisely. Think about it philosophically for a second. If your financial payout is locked at exactly the same number, whether the stock goes to the moon or crashes to the floor, why on earth would you care if it has a 90% chance of going up or a 10% chance of going up?
I wouldn't.
Exactly. The direction doesn't matter to you anymore. You have successfully immunized yourself against direction.
That is wild. So the market maker literally does not care if we are in the greatest bull market in history or the most devastating bear market. The trend is totally meaningless to the price of the derivative.
They do not care about the trend at all. However, we have to be very careful to specify what they do care about.
Okay, what do they care about?
We prove that we don't care about the direction, but the framework makes it abundantly clear we care deeply, intimately, about the stock's price range. We care about the volatility.
Meaning we care that the potential jump is precisely from 100 to either 101 or 99. If the jump was from 100 to 110 or down to 90, the option price would be entirely different. The hedge ratio would be entirely different, even if those 60-40 probabilities remained exactly the same.
Exactly. The sheer width of the potential movement, the volatility that dictates the potential payout of the option and the mechanics of the shield you have to build. But the likelihood of hitting the upper bound versus hitting the lower bound, completely irrelevant the moment you are perfectly delta hedged.
Okay, I conceptually grasp the math. I see the absolute logic of why the theoretical price must be 50 cents.
Good.
But this raises a massive practical question for me. It is one thing for us to solve an elegant equation on a chalkboard in our sterile sandbox and declare, the theoretical price is 50 cents.
Right. Theory is easy.
It is an entirely different thing for the chaotic, screaming, irrational trading floor of the stock exchange to actually agree with us. How do we know the actual chaotic floor of the market will respect our tidy little 50-cent valuation?
Because if the market decides to disrespect the math, it creates a scenario that the financial system is aggressively designed to exploit.
Oh, okay. Explain that.
If the market price deviates from the theoretical price, it creates risk-free, guaranteed money. And the market hates leaving free money on the table more than it hates absolutely anything else.
So we rely on the no arbitrage principle not just as a theory, but as a literal physical force.
Yes, a gravitational force.
Let's look at the mechanics of what happens when arbitrage actually exists in the wild. Let's say we log into our brokerage account and the market is acting irrationally. There is a panic or maybe a wave of euphoria. And for some reason, this specific option is currently trading for 40 cents.
Okay, so it's too cheap.
Right. It is glaringly underpriced compared to our perfect mathematical 50-cent valuation. How does a professional quant actually exploit that?
As a professional, you don't just buy the underpriced option and sit around hoping the price corrects itself eventually.
Because that would just be gambling again.
Exactly. Instead, you execute the entire hedged portfolio simultaneously.
Yeah.
You buy the undervalued asset, and in the exact same fraction of a second, you hedge it to eliminate the risk.
So the option is too cheap at 40 cents. I buy it. That is 40 cents out of my pocket.
Yeah.
But instantly, to build my shield, I short sell half a share of the stock.
Right.
The stock is sitting at 100, so shorting half a share injects $50 in cash into my account today.
So evaluate your net cash position at this exact moment. What do you have?
Well, I received $50 in cash from the short sale. I paid out 40 cents for the cheap option. So right now, today, I am sitting on a positive net cash pile of $49.60.
Good. Now, fast forward to tomorrow. We already proved the mathematical certainty of tomorrow's outcome.
Right. Tomorrow, regardless of whether the stock surges to 101 or crashes to 99, my portfolio, the payout of the option minus what it costs me to buy back the shorted stock, will absolutely, undeniably cost me exactly $49.50. I will have to pay out $49.5.
And how much cash did you collect today?
I collected $49.60 today. Tomorrow, my maximum liability is mathematically capped at $49.50.
And the difference?
The difference between the cash I am holding and the debt I owe is exactly 10 cents. I just manufactured 10 cents of pure, guaranteed profit out of thin air. It doesn't matter what the stock does. It doesn't matter what the Federal Reserve does. It is a mathematical certainty.
And that 10 cents is completely risk-free. It is a pure arbitrage profit. Now, consider the reverse scenario. What if the market is overly euphoric and the option is mispriced at 60 cents? It's too expensive.
Then I just flip the entire machine in reverse, right?
Exactly. Walk me through it.
I sell the overvalued option to some greedy speculator collecting 60 cents today. To hedge that exposure, I buy half a share of stock, which cost me $50. So my net cash flow today is negative $49.40. I spent $49.4 to build the position.
And what happens to that reverse portfolio tomorrow?
Tomorrow, my hedged portfolio is guaranteed to be worth positive $49.50. The math just perfectly mirrors itself.
Right.
If the stock goes up, I owe $1 on the option I sold, but my half share of stock is worth 50.5, netting me 49.5. If the stock goes down, the option I sold expires worthless, I owe nothing, and my stock is worth 49.5. Either way, 49.5 flows back to me.
So you spent 49.4 today, and you are mathematically guaranteed to receive 49.5 tomorrow.
Again, exactly 10 cents in guaranteed risk-free profit.
Now, zoom out for a second and connect this to the reality of modern finance. Imagine you are a multi-billion-dollar hedge fund.
Okay.
You have server farms collocated right next to the exchange running automated trading algorithms that scan millions of prices a second. If your algorithm spots an opportunity to make a guaranteed 10 cents with absolutely zero risk, how many times is that algorithm going to execute that trade?
Oh, it is going to execute it 10 million times. It is going to leverage every single dollar of capital the fund has to do it as massively and as quickly as possible until the money printer physically breaks.
Exactly. And when you and every other high-frequency algorithm in the world suddenly rush in to buy that undervalued option at 40 cents, what happens to the dynamics of the order book?
Well, that massive, concentrated wave of demand acts like a physical force. It instantly bids the price up. 41 cents, 42, 45.
And if it is overvalued at 60 cents, the massive wave of short selling floods the supply, driving the price instantly down, 59, 57, 54.
And when does this relentless frenzy finally stop?
It only stops at the exact moment the price hits 50 cents.
Right.
Because at exactly 50 cents, the risk-free profit drops to zero. The arbitrage opportunity completely evaporates. The algorithm shut off. So this theoretical price we calculated isn't just an academic exercise for a textbook.
It's the reality.
It is the absolute center of gravity for the market, the ruthless algorithmic pursuit of these tiny risk-free margins instantly crushes the market price back to the theoretical price. The market price has to obey the math because the math is violently enforced by greed.
That is incredibly satisfying to understand. It is not just abstract modeling. It is the actual physics of market microstructure. We have established that the chalkboard dictates reality.
Yes.
But let's expand our toolkit, because in our first sandbox example, we just magically knew that the correct hedge was to short exactly 1/2 of a share. It was given to us. But how do quants find that magic ratio for any stock with any potential price swing in the real world?
To do that, the quantitative framework relies on a vital concept, denoted by a Greek letter that is ubiquitous on trading floors.
Which is?
Delta. Delta represents the exact precise fraction of the underlying stock that must be bought or sold to perfectly hedge one single option contract.
And the beauty is, there is a surprisingly simple general formula for calculating delta in this discrete model. It says delta equals the range of the option's potential payoffs divided by the range of the stock's potential prices.
Let's pull that formula out of the abstract and test it against a new, slightly more complex sandbox environment.
Okay, let's reset the board. The stock is currently sitting at $100 again, but this time the volatility is higher and slightly skewed. Tomorrow, it can either surge up to 103 or it can fall to 98.
Notice the asymmetry there. It is an up move of 3, but a down move of only 2. The total spread is wider.
We still have our standard call option with a strike price of 100. So let's calculate the two ranges for our delta formula. First, the range of the stock prices. It can max out at 103 or bottom out at 98.
Right.
The total distance between those two extreme bounds is $5. So the denominator, the range of stock prices, is 5.
Now the numerator. The potential outcomes for the option. If the stock rips to 103, your option with the strike of 100 pays out $3.
Yeah.
If the stock falls to 98, the option is underwater and expires worthless, paying out 0.
So the potential payouts are 3 and 0. The distance between them is 3. The range of option payoffs is 3.
Apply the delta formula. Option range divided by stock range.
3 divided by 5, which is a 0.6. So our magic hedge ratio for this specific asymmetrical setup is 0.6. We need to short exactly 0.6 shares of the underlying stock for every single option contract we hold.
Let's verify it conceptually, just to ensure the structural integrity of the shield holds up under these new conditions.
Good idea.
You hold one option, and you carry a short position of 0.6 shares.
Okay, scenario A. The stock surges to 103. My option pays out $3. My short liability is 0.6 shares multiplied by the new price of 103. That means it costs me $61.80 to buy back the shares.
So do the netting.
I have $3 from the option minus the 61.8 I owe. My net portfolio value is negative $58.80.
Scenario B. The stock drops to 98. The option pays out 0. Your short liability is 0.6 share at $98 each. That costs you $58.80 to cover. 0 from the option minus the 58.8 you owe.
The net value is negative 58.8. It works perfectly.
There you go.
The asymmetry didn't matter. The value is locked at negative 58.8, regardless of whether the stock hits the high bound or the low bound. The directional risk is completely eliminated.
So, applying the law of gravity, the no arbitrage principle, what is the value of this new option today, assuming we are still in our zero interest rate vacuum?
negative 58.8. The present must be negative 58.8. The portfolio today is the unknown option price V minus the cash from the short stock. We shorted zero point 0.6 shares at today's price of 100. That puts $60 in our pocket today. So V minus 60 equals negative 58.8. Move the 60 over V equals 1.2. The option is worth exactly $1.20.
The logic holds up perfectly. Now we have a generalized mechanism to find the delta hedge ratio and the fair price for any discrete jump, no matter how volatile or asymmetrical.
It's a universal tool.
But as we build this toward reality, we have to start introducing real-world friction. We cannot ignore interest rates forever. Money today is simply not the same biological entity as money tomorrow.
Right. If I take cash and literally bury it under my mattress, it implicitly loses value compared to putting it in a treasury bond that pays a yield. We have to account for the cost of capital. How does this beautiful, balanced architecture change if the risk-free interest rate is, say, a very high 10%?
The absolute most elegant part of this framework is that the hedge ratio itself, the delta, does not change one single bit.
Really? Not at all.
Not at all. The mathematical mechanics of isolating and eliminating the directional risk are entirely unaffected by the cost of borrowing money. You still short 0.5 shares in the first scenario or 0.6 shares in the second scenario. The shield remains perfectly intact.
Oh, I see. What fundamentally changes is how we value that guaranteed future cash flow when we bring it back to the present day.
Exactly. We must execute a present value calculation. We cannot just equate tomorrow's dollar directly to today's dollar anymore. We have to discount tomorrow's guaranteed amount back to today's terms.
Let's go back to our very first sandbox to see how this works. The stock goes from 100 up to 101 or down to 99. The delta was 0.5. And the mathematically guaranteed portfolio value tomorrow was negative 49.5.
But now, with a 10% interest rate environment, we cannot just say, a debt of 49.5 tomorrow means a value of 49.5 today.
Right, because of the interest.
Because if you held exactly negative 49.5 today, and you were charged a 10% annualized interest rate on that balance overnight, your debt would grow. You would owe slightly more tomorrow. We need to find the specific, slightly smaller amount of cash today that, when interest is applied, grows to precisely negative 49.5 tomorrow.
So we use a discount factor. We take the 10% annual rate, divide it by the number of trading days in a year to get the daily rate, and calculate the discount. Let's say that daily discount factor works out to 0.9996. It is very close to 1, but just slightly less.
So you take your guaranteed tomorrow value, negative 49.5, and you multiply it by that precise discount factor of 0.9996.
And that gives us a present value of roughly negative 49.48. That slightly smaller number is the true economic value of the portfolio today, perfectly adjusted for the time value of money.
Now run the final algebra to solve for the option price, V, under these new conditions.
Okay, the equation is V minus the $50 from the short sale today equals our new discounted present value of negative 49.48. Add 50 to both sides. V equals 0.5, 2, or 52 cents.
Look closely at what just happened to the price.
Yeah, it went up.
In our zero interest vacuum, the option was worth exactly 50 cents. But simply by introducing a 10% interest rate, the option's fair value drifted slightly upward to 52 cents. Why do you think that is?
I think it's because of the inherent leverage of an option, right? Holding the call option gives you full exposure to the upside of the stock without forcing you to tie up the entire $100 required to actually buy the shares.
Spot on.
In a high interest rate environment, cash is incredibly valuable. It is expensive to borrow, and it earns high yields if you hold it. Because the option allows you to keep your cash in the bank earning that 10% yield while still getting the upside exposure, that structural leverage becomes mathematically more valuable. The framework seamlessly accounts for all of these hidden macroeconomic dynamics.
It is a breathtakingly elegant system. However, there is a glaring practical problem.
What's the catch?
Constructing these hypothetical portfolios, manually calculating the delta ratio for every specific jump, projecting the opposing future values, painstakingly discounting them back to the present. It is computationally exhausting.
Yeah, I could see that taking forever.
If you are a market maker trying to price a book of thousands of options that expire in 6 months, doing this step-by-step hedge calculation for every possible path is paralyzing.
Which brings us to arguably the most fascinating philosophical leap in the entire quantitative framework. Because mathematicians and quants at their core are wonderfully, brilliantly lazy.
They absolutely are.
They do not want to calculate infinite hypothetical hedging portfolios if they don't have to. They want a shortcut.
And to create that shortcut, they essentially engineered an entirely alternate universe, a theoretical dimension that bypasses the friction of the real world.
We are talking about the transition from the real world to what is known as the risk-neutral world. This is such a bizarre concept, so let's unpack it carefully. Let's define the real world first, the one you and I actually invest our retirement money in.
Okay.
In the real world, investors fundamentally demand what is called a risk premium.
It is a very simple, deeply human concept. It is rooted in psychology.
Right.
If I offer you a perfectly safe government treasury bond that guarantees a 5% return, or I offer you a wildly volatile tech stock that might return 5% on average, but might also lose half of its value, you, as a rational, risk-averse human being, are only going to buy the chaotic stock if I promise you an expected return that is significantly higher than that, say, 5%.
Right. It is exactly like deciding whether to get on a roller coaster.
Yeah.
You only strap yourself into a terrifying, upside-down, triple-loop roller coaster if the thrill, the expected return, massively outweighs the primal terror of the risk.
That's a great way to put it.
If a gentle kiddie ride and the terrifying roller coaster offered the exact same level of thrill, nobody would ever subject themselves to the terror of the big one. Human investors must be financially compensated for the sheer emotional and financial terror of taking on risk. That extra compensation is the risk premium.
That is the fundamental psychological law of the real world. We avoid risk unless we are paid to take it. But what is the defining characteristic of this risk-neutral planet the quants invented?
This is where it gets wonderfully weird. Imagine a planet where investors literally do not possess the capacity to feel fear. They are purely logical, emotionless robots.
No fear at all.
They feel absolutely zero terror on the roller coaster. To them, a guaranteed 5% return from a safe bond and a wildly volatile investment that averages a 5% return are seen as perfectly mathematically identical. They require zero extra compensation, zero risk premium for taking on massive amounts of unnecessary risk.
In this hypothetical world, every single asset, no matter how safe or how insanely volatile, is priced solely and purely on its raw mathematical expected value. Volatility is entirely stripped of its psychological weight.
So the obvious question is, why do we care? How does imagining a sci-fi planet of emotionless robot investors help us price a real option here on Earth?
We use this imaginary planet to calculate a fake probability, a mathematical skeleton key, if you will.
Okay, show me how that works.
Let's go all the way back to our very first sandbox. The stock is at 100 today. Tomorrow it goes to 101 or 99. In the real world, our analysts told us the probability of going up was 60%.
Right, which meant the real-world expected value of the stock tomorrow was $100.20. You weight the 101 by 60%, the 99 by 40%, and you get 100.2. But the stock is currently priced at exactly 100 today. That extra 20 cents of expected growth tomorrow, that is the real-world risk premium. That is the extra compensation investors demand for holding the risky stock instead of a safe 0% cash pile.
Exactly. The real world demands growth to justify the risk. But let's completely erase that. Let's pretend, for just a moment, we are teleported to the risk-neutral planet.
Okay, beaming up now.
If we are on that planet, and the stock is correctly priced at 100 today, what must its expected value be tomorrow? Remember, investors here demand zero risk premium.
If they demand zero risk premium and interest rates are zero, then the expected value tomorrow must be exactly the same as the price today. It must be exactly 100. It earns nothing extra for the risk.
So we can set up a completely new equation. We ask ourselves, what hypothetical fake probability, let's call it TAMBRO, would force the expected value of tomorrow's coin toss to perfectly equal 100? The mathematical setup is P prime multiplied by the upcase of 101 plus the remaining probability, which is 1 minus P prime multiplied by the downcase of 99, must perfectly equal 100.
We are intentionally solving for a probability that eliminates the risk premium. And if you run that basic algebra, you distribute the terms, you get 101 P prime plus 99 minus 99 P prime equals 100. You consolidate the P primes to P prime equals 1. Divide by 2. Therefore, P prime equals exactly 0.5 50%.
The risk-neutral probability of the stock going up magically shakes out to exactly 50%.
And now, here is the absolute prestige of the magic trick. The entire reason the binomial model is so brilliant. Take that totally fake, mathematically manufactured risk-neutral probability of 50% and use it to price the option using the exact same naive expected value logic the gambler tried to use at the very beginning of our conversation.
Let's execute the gambler's calculation using the fate probability.
The gambler's calculation. Okay. The option pays $1 if the stock goes up and $0 if it goes down. Using our fake 50% probability, you weight the $1 payout by that 50% probability, which gives you 50 cents. You weight the 0 payout by the other 50%, which gives you 0. Add them up. You land perfectly on an expected value of 50 cents.
You get 50 cents.
Which is the exact, precise option price we arrived at after doing all that exhausting, labor-intensive delta hedging math. We built the portfolio, we balanced the short position, we applied the no arbitrage principle, and we got 50 cents. Here, we just derived a fake probability, ran a middle school expected value calculation, and got the exact same answer instantly.
And that is the massive conceptual breakthrough. Quantitative analysts do not use risk-neutral probabilities because they are delusional. They don't actually believe that human investors don't care about risk.
Of course not.
They know perfectly well that the real world has a risk premium and that people are terrified of losing money.
Right. They aren't ignoring human psychology. They are mathematically bypassing it.
They use this risk-neutral framework because it is a massive, mathematically proven shortcut. Think back to our no arbitrage proof. We proved definitively that the real-world probability that 60% guess is entirely, fundamentally irrelevant to the option price because the delta hedge neutralizes the direction.
Yes, we proved that.
Because the real probability is irrelevant, we are mathematically free to substitute absolutely any probability we want into the equations as long as it makes the math easier to solve.
And 50% makes it super easy.
And the probability that makes the math easiest is the risk-neutral one. It allows us to calculate the undeniably correct arbitrage-enforced option price using a ridiculously simple expected value formula, completely skipping the agonizing process of calculating the hedge ratio at every single step.
It is like needing to get to the other side of a massive, treacherous mountain range. The delta hedging method is like manually hiking over every single jagged peak it gets you there, but it is exhausting.
Right, it takes forever.
The risk-neutral method is discovering a perfectly smooth, straight tunnel bored directly through the base of the mountain. The destination is exactly the same, but the journey is infinitely faster and requires a fraction of the energy.
This incredible shortcut is what allows us to scale the model up. Which brings us to the next massive challenge. We have been playing in sandboxes with rigid, discrete numbers, 100, 101, 99. But to prepare this framework to handle the chaotic reality of the actual stock market, we have to transition from specific numbers to a generalized system of algebraic symbols.
Right. We need to build a machine that works for any stock at any price with any volatility. The framework introduces the standard algebraic vocabulary used by quants everywhere. We have S representing the current stock price.
Yep.
We have S representing the up multiplier, the percentage the stock jumps if things go well. We have V representing the down multiplier, and we have P, our magical risk-neutral probability.
So instead of explicitly saying 100 goes to 101, we generalize it. The state S branches out to either U times S or V times S.
But here is the core structural challenge of building this machine. To make this discrete binomial model, this chunky, step-by-step branching tree map accurately to reality, we have to ensure its growth and its volatility perfectly match how stocks actually move in continuous time.
That's the hard part.
The framework explicitly mentions that stocks follow a continuous time log normal random walk. How do we intelligently pick the right values for U, V, and P to force our chunky, blocky model to act like a fluid, realistic stock?
It is a classic engineering problem of constraints. We only have two mathematical equations to work with. We need one equation to perfectly match the mean change, the expected return, or drift of the stock. And we need a second equation to perfectly match the variance, the volatility, or the width of the swings.
But we have three completely unknown variables. We have U, V, and PS as a known current price, but the up jump, the down jump, and the probability are all blank slates. We have two equations, but three unknowns. Algebraically, that means we are under-constrained.
Which means, as the framework notes, there are literally an infinite number of mathematical solutions. There are infinite ways to draw a binomial tree that successfully matches the target mean and variance. You could have a huge up jump and a tiny down jump with a weird probability, or symmetrical jumps with a different probability.
So if there are infinite ways to build the machine, how do the quants agree on which one to use?
They optimize for elegance. They pick the solution that is the neatest and computationally cleanest. The standard method used universally for teaching this, famously formulated by Cox, Ross, and Rubinstein, decides to set the multipliers U and V based entirely and purely on the stock's volatility, represented by the Greek letter sigma, and the size of the time step, delta t.
The actual formula looks a bit intimidating at first glance. It defines U as e raised to the power of sigma times the square root of delta t, and v is just e raised to the negative sigma times the square root of delta t.
Right, it looks like a lot of Greek.
But when you strip away the Greek, it just means that the up and down jumps are perfectly symmetrical on a percentage basis, and their size is entirely 100% dictated by how volatile the stock is over that specific tiny slice of time.
Exactly. You lock in U and V based purely on volatility. And once those two are locked in, you derive the probability P to ensure the expected mean return matches reality. The three variables are solved.
But here is where I have to step in with a reality check, because I am looking at this log normal random walk concept. Why are we only obsessing over matching the mean and the standard deviation? Doesn't the actual physical shape of the stock's path matter?
What do you mean by shape?
Real stocks don't just rigidly jump between two precise discrete points like a metronome. They wiggle randomly, they have fat tails, they skew. If our tree only allows for two rigid outcomes per step, how can it possibly simulate the organic, chaotic curve of a real stock chart?
That is the perfect question to ask. And the framework provides a brilliant, elegant answer to it. It relies on a principle from deep statistics, the central limit theorem.
The central limit theorem. This is the bridge between the discrete and the continuous.
Yes. It is one of the most powerful forces in probability. It states that if you take a large enough number of independent random variables, even if they are incredibly crude, simplistic variables like our rigid binary coin flips, and you add them all up, their aggregated normalized sum will relentlessly tend toward a normal distribution, a smooth bell curve.
Think of a Galton board, those pegboards where you drop a marble and it bounces left or right off the pegs.
Yes, exactly that.
One single step in our binomial tree where S goes to US or VS is totally rigid and binary. It looks absolutely nothing like the fluid chart of a real stock. But if you take 1,000 tiny steps, if you drop 1,000 marbles through the pegs, the aggregate shape at the bottom naturally, inevitably curves into a perfectly smooth log normal distribution. We don't have to force our model to have a complex, curvy shape. If we just spring enough simple steps together, the sheer weight of the math naturally generates the fluid shape for us.
Which perfectly transitions us to the next phase of the architecture. Because valuing an option that expires in 24 hours using a one-step sandbox is easy. But what about a real option that expires in 3 months or a year?
One single day into the future isn't enough. We need to string these tiny one-day models together. We expand that single V-shape into a sprawling, interconnected branching tree.
Let's visualize this geometry. At the far left of your screen, you have a single dot. That is today's reality. The current stock price, S.
From that single dot, 2 branches sprout out to the right. One branch goes up to the node US, and one branch goes down to the node ES. That completes day 1.
Now, the tree grows. From each of those 2 new dots, 2 more branches sprout to the right. From the top node US, it branches up to U squared S, and it branches down to UVS.
And from the bottom node VS, it branches up to UVS, and it branches down to V squared S. Notice what just happened in the middle there. UVS is the exact same price node. The tree recombines.
Exactly, it fills back on itself.
An up jump followed by a down jump lands you at the exact same price as a down jump followed by an up jump. This recombination is crucial. Instead of the number of nodes exploding exponentially into total chaos, it forms a neat, organized diamond pattern that slowly expands outward over time.
And if you visualize this tree, the framework includes a very specific note about its physical shape. It points out how the tree visually bends outward as it grows to the right. It does not form a perfectly straight, symmetrical triangle.
Right, and that is because of the geometric, compounding nature of asset growth. We are multiplying the stock by percentages U and V rather than simply adding fixed, rigid dollar amounts.
To think about the difference there.
If a $100 stock goes up 10%, it gains $10. But if that stock grows to $200 and then goes up 10%, it gains $20. The absolute dollar jumps get physically larger as the stock price climbs. So the top branches of the tree, representing the massive bull runs, curve upward much steeper and faster than the bottom branches curve downward. A stock can go to infinity, but it can only fall to zero.
So now we have constructed this massive, sprawling, geometrically bending tree. It might have hundreds or even thousands of tiny time steps stretching all the way out to the option's expiration day on the far right side of the screen. How on earth do you systematically price an option on a structure this massive and complex?
Well, you don't start at the beginning. You use an algorithm called backward induction, the absolute key to solving the mazes. You have to start at the end and work backwards.
Step 1. You fast forward time and jump all the way to the absolute right edge of the tree. This final column of nodes represents expiration day. And at these final nodes, the option values are no longer theoretical. They are perfectly mathematically known.
Because at the moment of expiration, all the fog of uncertainty evaporates. The option simply devolves into its raw intrinsic payoff. If the final stock node is sitting above the strike price, the option value is precisely the difference between the two. If the stock node is below the stripe, the option value is a hard zero. You possess absolute unassailable ground truth numbers for the entire right-hand boundary of the tree.
Step 2. You take one single step backward in time, leaving to the second to last column. For every single node in this column, you look forward at the two possible future nodes it connects to. And you use that beautiful risk-neutral shortcut equation we derived earlier to calculate its value.
You don't calculate hedge ratios. You just take the fake risk-neutral probability of the upper future node, add the remaining probability of the lower future node, discount that expected value back one step using the interest rate, and boom! You've perfectly calculated the fair value of the option at that specific node one step before expiration.
Step 3. You feed this into a loop. You just repeat the process. You sweep backwards relentlessly down the tree, column by column, node by node. Every time you calculate a column, that column becomes the new known future for the column before it. You collapse the sprawling labyrinth of possibilities, step by step, drawing the value leftward, until you finally hit the single root node on the far left.
And that single consolidated number resting at the root node is your final mathematically perfect option price for today. I absolutely love the conceptual elegance of this. It is exactly like solving a massive maze by starting at finish line. Because the end state expiration day is the only place in the entire timeline where you possess absolute truth, you are forced to systematically drag that truth backward through the labyrinth of probabilities until it reaches the present moment.
It is a computationally heavy process. Doing it by hand for 100 steps would take a lifetime. But logically, it is flawless. And a modern computer can sweep backward through a 10,000-step tree in a fraction of a millisecond.
Which sets the perfect stage for our grand finale. We are moving to the culmination of all this logic. We are talking about approaching infinity, the transition to the holy grail of quantitative finance, the Black-Scholes model.
Think about the evolution of the machine we just built. First, we built a simple tree with massive one-day steps. Then maybe we refined it and built one with 1-hour steps. As the jumps get smaller, the tree gets denser, the branches pack tighter together, the resolution improves. But what happens if our time step delta isn't an hour? What if it's a minute, a second, a microsecond?
What happens if we push the math to the absolute extreme? What happens if we take the mathematical limit as delta tall approaches exactly zero?
The framework gently walks us through the conceptual mechanics of this transition. We do not need to get bogged down in the dense algebraic proofs. But conceptually, we are executing a profound transformation. We are replacing those discrete, chunky, disconnected tree nodes with a perfectly smooth, continuous mathematical surface. We stop talking about discrete, isolated values at specific times, and we start talking about a fluid, continuous function. We describe the option's value, V, as a seamless, flowing function of the stock price, S in time t,
V of S, comma t. The value of the derivative reacts instantly and smoothly to every microscopic twitch of the underlying stock and every passing millisecond of time.
To make this leap from chunky blocks to fluid motion, mathematicians utilize a tool called a Taylor expansion. It is a way to approximate the behavior of complex functions. It allows them to take those tiny, microscopic, discrete jumps of the binomial tree and express them as smooth, continuous rates of change as derivatives in the calculus sense. The discrete algebra of our branching tree gracefully, inevitably transforms into a continuous differential equation.
And when the dense cloud of algebra finally settles, the framework reveals the resulting masterpiece. It is an equation that looks utterly terrifying when written on a chalkboard. It reads, The partial derivative of v with respect to time plus 1/2 times sigma squared times s squared times the second derivative of v with respect to s plus the risk-free rate times s times the derivative of v with respect to s minus the risk-free rate times v perfectly equals 0.
That intimidating string of calculus is none other than the legendary Black-Scholes equation. It is the formula that literally revolutionized Wall Street. It birthed the multi-trillion-dollar modern derivatives market. It is the equation that won a Nobel Prize in economics.
And this is what I want everyone listening to deeply, truly internalize. This is the payoff of the entire deep dive, the profound hidden beauty of this connection. That terrifying Nobel Prize-winning Black-Scholes continuous time differential equation, which looks to the layman like an alien language, is not magic. It is not some incomprehensible physics discovered in a vacuum. It is simply the logical, mathematical, inescapable extreme of our incredibly basic, rigged coin flip 101 or 99 hedging exercise in the sandbox.
It all comes down to the exact same fundamental principle we established in minute 1, eliminating risk. Whether you are manually calculating a two-step tree on a napkin or you are running a continuous differential equation on a supercomputer, you are doing the exact same thing. You are constructing a theoretical portfolio where the directional movements perfectly cancel each other out, leaving you with a guaranteed outcome that must, by the laws of financial gravity, equal the risk-free rate of return. The Black-Scholes equation is literally just the binomial model played out at infinite speed.
Okay, let's pull all of this incredible theory together. Let's recap the journey we just took from the sandbox to the Nobel Prize. We started with the painfully simple construct and learned that delta hedging the act of holding an option while simultaneously shorting a mathematically precise ratio of the underlying stock perfectly eliminates all directional risk from a portfolio.
We learned that because that directional risk is completely eliminated, the real-world probability of the stock going up or down becomes fundamentally completely irrelevant to pricing the derivative. The market stops caring about the trend and only cares about the width of the volatility and the cost of borrowing money.
We learned that the risk-neutral world isn't the delusion of an out-of-touch academic. It is a brilliant, highly pragmatic mathematical shortcut that intentionally uses fake probabilities to bypass the agonizingly tedious calculation of endless hedge ratios.
And finally, we saw how a simple, chunky branching tree of discrete coin flips can evolve, relying on the central limit theorem and the calculus of infinitesimal limits into the fluid, continuous time mathematics of modern quantitative finance, culminating in the elegant perfection of the Black-Scholes equation.
But before we let you go, we want to leave you with a final, highly provocative challenge. A thought to mull over that stress tests the fundamental assumption underlying everything we've talked about today.
Because both the discrete binomial model and the continuous Black-Scholes equation rely absolutely on one crucial load-bearing assumption, the assumption of continuity. They both assume that you, the market maker, can always smoothly, cleanly rehedge your portfolio at every tiny fractional time step. As the stock glides from S to US, you can seamlessly buy or sell fractions of a share to continuously adjust your perfectly balanced belt to shield.
But think about the harsh, violent reality of the actual stock market. Think about a flash crash. What happens when a stock refuses to smoothly glide down the branches of our beautifully engineered tree? What happens if a piece of catastrophic macroeconomic news hits the wire, or an algorithmic feedback loop triggers, and a stock instantly, violently gaps down from 100 straight to 80? It completely skips trading at 99, 95, 90, and 85. Those prices cease to exist.
If that happens, the continuity shatters. If you are holding an options portfolio and you physically cannot dynamically adjust your delta hedge because the market is moving too fast for your algorithms to execute, or because liquidity has completely evaporated and there is literally no one on the other side of the order book to trade with.
Does the invincible, mathematically perfect armor of no arbitrage shatter? Does the perfectly engineered, risk-free portfolio suddenly become a terrifying financial trap, exposing the market maker to infinite losses? It is a genuinely terrifying question for anyone running a trading desk. The brilliant math of quantitative finance assumes the market is a smooth, continuous, navigable river. But sometimes, without warning, the market is a jagged waterfall. That is something to deeply ponder the next time you see extreme volatility spike on your screens, and you wonder if the elegant mathematical models are actually holding up under the crushing pressure of reality.